Of all the homes sold in Texas in 2021, 28% of them were purchased by investors. Some have argued that's the primary reason we saw those huge price run-ups back then. The argument goes like this. If inventory is already low, and 1/3 of the homes available are scooped up by investors, that means that all the people out there trying to buy a home that they can live in will have fewer to choose from and probably have to pay more because of the increased competition. Let's break down the how and the why of this and try to figure out how that big block of investor-owned homes is impacting the housing market now and what impact we can expect in the future. First, let's talk about who these investors are because they come in a lot of different sizes. An investor can be as small as an individual or a single person LLC, all the way up to a large publicly traded company like Blackstone that owns over 60,000 houses. And they're not even the biggest. Now, regardless of how big the investor's portfolio might be, all of them are going to buy a house for only one of two reasons. They're either going to rent that house or they're going to want to improve it and then resell it. In other words, just like all those TV shows out there, they're going to fix it and then flip it for a profit. Now, it's important to point out that the only reason an investor is going to do either one of these two things is to make money. If you could finance a house with a mortgage payment of $2,000 and then rent it out for $2,500, that means you'd have $500 of positive cash flow, and that tenant is going to pay down your mortgage. And this doesn't even include the tax benefits of depreciating a house that is probably going to be increasing in value. Now, for a flip, you might buy the house for $300,000 and spend about $50,000 remodeling it and then try to sell it for $500,000. If the numbers make sense and that investor can make money, they're going to buy the house. Now, all of this works when the cost to borrow money is low and houses are appreciating. But when interest rates rise and the value of those houses begin to stagnate or begin to decline, that investment home could quickly move into negative territory. And this is exactly what happened back in early 2022 when mortgage rates began to rise and people became less willing to pay those inflated prices from the pandemic housing boom. We saw fewer transactions and prices on homes began to decrease. Last year, Austin saw a 10% decline in the median price for a home, which is the largest decline in the entire country. Now, to put that in perspective, if you bought a home, spent a couple of months remodeling it, and planned to sell it for $500,000, but could only get $450,000, that could very easily be the difference between a profit and a loss. And if you couldn't sell it for what you needed to get for it, you might decide to hold on to it, which is exactly what a lot of investors did. But we're 2 years into these elevated mortgage rates. So how much additional cost do you think someone has incurred by holding on to a house 2 years longer than they originally intended? In other words, it becomes harder and harder to even break even if you have to hold on to that house hoping that prices will somehow come back to where you think they should be. Now, reporting does show that the number of investor transactions did decline when those mortgage rates began to rise, but they did happen, and the ones purchased in 2021 were never sold because the investor couldn't get the kind of money that they needed to. Now, there were some exceptions. Do you remember when Zillow shut down their home flipping division because they lost $500 million in one quarter? They liquidated all their homes and sold them for whatever it is they could get for them. Now, they did get lucky, at least in the Austin area, because when those houses first started showing up on the MLS, in some neighborhoods, they were the only houses available, which meant they got multiple offers and might have actually made some money on some of those houses. I don't know how close they came to recovering that $500 million loss, but I do know this. A smaller investor would never be able to absorb that kind of loss and continue to operate. And most are unwilling to cut their losses and move on because that loss is very personal, and they usually underestimate how long it might take for the market to begin to move the other way. Consider this. When mortgage rates first began to rise in March of 2022, almost every expert out there was predicting that this was temporary and that by December of that same year, we were going to be back to normal again. But now it's 2 years later and the Fed is still not ready to start reducing the federal funds rate. So if you're not willing to sell the house unless you can get what you think it's worth, and you're not willing to liquidate, take your losses and move on, the other option would be to rent it out to get some kind of income coming in until prices begin to improve. Which brings us to rentals. Let me ask you this. Why do you think there are so many renters in the Austin metro? I'm talking about people who have the income and the credit to be able to buy a house, but they choose to rent instead. If those types of people didn't exist, the rental market would not be as strong as it currently is. My theory is they prioritize short-term needs over long-term benefits. Here's an example. If I can rent in an area that I can't afford to buy in, but that area has better amenities, better location, maybe a better school district. If I focus on those short-term needs, it probably makes more sense to rent there as opposed to spending that exact same amount of money every month to buy a house in an area that I can afford. Now, whatever the real reason is, landlords love those kind of people, and there seem to be a lot of them out there in this Austin metro. But if you have a rental property, or if you're thinking about becoming an investor yourself, the question is what does the future of the Austin rental market look like? Let me throw this one at you. New York City has 8 times the number of people than Austin. And last year, there were 10,000 new apartment units that were brought online in New York City. But Austin, with 1/8 the number of people, a little over a million, Austin brought on 17,000. And they're still building all over the metro. Another fun fact, last year was the first time in 20 years that Austin saw a net population decrease. So, if home prices are stagnating or declining, mortgage rates remain elevated, more and more rental units are becoming available every year, but there are less people moving to Austin, do you think it's reasonable to expect that future rents are going to go up or down? Now, if you like this video, you might like this other one that I did. And don't forget to subscribe to my channel and ring the bell. That way you'll get a notification every time I post a new video.